Hello everyone, today we're going to discuss a counterintuitive economic phenomenon. Have you ever wondered why a country's exports should become more competitive when its currency depreciates? After all, cheaper domestic goods sold abroad should make the country more competitive, shouldn't they? Yet India defies this logic. By 2025, the rupee had depreciated by over 7% against the dollar, reaching a historic low. However, rather than rising, exports fell by 5.8%, while the trade deficit ballooned to $236 billion. Doesn't this seem highly unusual? Why does classic exchange rate logic fail in India? Today, we will examine this phenomenon in more detail, as the trouble caused by the rupee's depreciation extends far beyond mere export profitability. Its effects are far-reaching, impacting the Indian economy through 5 channels. From stock markets and corporate confidence to the prices and wages that affect ordinary people. This case is absolutely exemplary for understanding the economic challenges facing emerging economies. Let's break it down step by step. First, we must dispel a common misconception. Many assume that currency depreciation equals export boom. While this might have been true in the past, it is entirely irrelevant to India today. Why? The core reason is simple. India is deeply embedded in global supply chains. Manufacturing anything domestically requires imported components. Let's clarify the concept of a global value chain. Put simply, it means that when a product is manufactured today, it is not produced entirely within a single country. Instead, components are distributed across different nations for production. Take the example of an iPhone assembled in India. The chip might come from the US, the screen from South Korea, and the core electronic components from China. India only handles the final assembly stage. In such a scenario, the export advantage gained from a depreciating rupee is quickly offset by rising costs for imported parts. Data supports this. A September 2025 report from the East Asia Institute of Economics states that India's share of the global economy increased from 1.5% in 2002 to 3.5% in 2022. Industries such as chemicals, pharmaceuticals, and auto parts are entirely dependent on imported intermediate goods for production. The electronics sector is particularly vulnerable, with 80% of car components being sourced from abroad, over 60% of which come from China. When the rupee depreciates, the cost of these parts skyrockets. By the time assembly is complete and exports are shipped, any price advantage gained from exchange rates has already been offset by the increased component costs. Examining China-India trade data further illuminates the issue. In the first 3 quarters of 2025, India imported $91.76 billion worth of goods from China, marking a 13.1% year-on-year increase. However, its exports to China totaled just $12.25 billion, resulting in an enormous trade deficit of $79.52 billion, more than double India's trade surplus with the United States. India later acknowledged its growing reliance on Chinese raw materials for industrial and export growth. Faced with this reality, it had no choice but to relax certain import controls on Chinese goods. For example, the bonded storage period for critical components was extended from 180 days to 18 months, enabling companies to procure Chinese supply chain parts more reliably. This indirectly reveals how dependent India's manufacturing sector is on external components, a dependency that is simply unavoidable. Turning to the specifics of the rupee's depreciation, 2025 saw the currency emerge as one of Asia's worst performers. At the start of the year, $1 was worth approximately 86 rupees. The currency then declined steadily, breaching the 91 rupee mark during intraday trading on the 16th of December, a historic low before closing at 90.95 that day, although the Reserve Bank of India intervened later in the year, pushing the exchange rate back to 89.85 by the end of the year. The overall downward trend remained unchanged. One might expect such significant depreciation to boost exports, but the opposite occurred. India's merchandise exports totaled $365 billion in 2025, marking a 5.8% year-on-year decline, while imports surged by 2.4% to $600 billion. thereby widening the trade deficit to $236 billion. Consider India's primary export category, electromechanical products, where 68% of components are imported, with essential parts accounting for over 80%. As the rupee depreciated, import costs for these parts skyrocketed, squeezing corporate profits. Consider Apple's assembly plants in India, for example. While phone exports increased slightly, core components such as chips and screens still had to be imported. Any exchange rate advantage was offset entirely by rising part costs, leaving no room for price reductions. To make matters worse, the US delivered a backhanded blow. Due to India's purchases of Russian energy and weapons, the US imposed 2 rounds of tariffs on Indian exports in 2025, resulting in a combined rate of 50%. Even more ruthless is the plan to increase the fee for the H-1B visa for high-skilled workers from a few $100s to $100,000. Over 70% of H-1B visa holders are Indian tech workers. This would deal a massive blow to India's IT services industry, which relies on the US market for over 60% of its revenue. Data confirms this. In the second half of 2025, India's exports to the US plummeted by 12.3% year-on-year, with traditional strengths such as textiles and electronics suffering the steepest declines. With costs rising due to the depreciating rupee and the US market shrinking under tariffs, how can India's exports possibly thrive? With no other option, India negotiated tariffs with the US while also improving relations with China, restoring direct flights and easing business visa restrictions. This shift was prompted by previous visa restrictions that cost India's electronics manufacturing sector $15 billion in output over 4 years. This demonstrates that the traditional devaluation boosts exports. Logic no longer applies to India's current economic structure and global environment. It should now be clear that rupee depreciation triggers not a single problem, but a cascade of chain reactions. As Bank of America has long noted, the impact of rupee depreciation spreads through 5 interconnected channels: sentiment, growth, inflation, external balance, and fiscal policy. These channels are not isolated. They interact and amplify each other, ultimately creating systemic shocks. Let's examine each channel to see how this web is tightening its grip on India's economy. The first and most direct channel is sentiment. Put simply, when confidence vanishes, capital flees. International investors are highly sensitive to currency fluctuations. As the rupee depreciates relentlessly, they worry that their Indian investments will lose value when converted back to dollars. Their immediate reaction is to withdraw their capital. In 2025 alone, foreign investors withdrew a net $18 billion from Indian stock markets, a recent record high, channeling these funds into dollar-denominated assets for safety. This exodus destabilized both the stock and bond markets. Although Mumbai's Sensex and Nifty indices remained at elevated levels, they exhibited extreme volatility, with daily swings exceeding 2% occurring 18 times, double the 8 instances seen in 2024. India's stock market has a large retail investor base. Seeing foreign investors sell, they followed suit, further amplifying volatility. However, a key detail emerged. Domestic institutional investors in India took advantage of the situation to purchase stocks at lower prices, with buying volumes even exceeding the scale of foreign capital outflows. This helped stabilize the market to some extent, preventing a full-blown stock market crash. Corporate confidence has been severely impacted, however. The Confederation of Indian Industries Q3 2025 survey revealed that the business confidence index had dropped by 4.2 points compared to the previous quarter. Over 60% of companies stated that they would proceed cautiously with investments and were reluctant to expand. Why? They fear further rupee depreciation, which would increase costs and make it difficult to recoup invested capital. This lack of confidence directly affects companies' long-term planning, which is certainly not conducive to economic growth. The second channel is the growth channel. This is the most crucial channel as it relates to economic growth and employment, which ordinary people care about most. While the traditional view is that depreciation can stimulate growth. In India's case, depreciation has actually constrained growth in both manufacturing and services. Let's examine manufacturing first. As previously discussed, India's manufacturing exports rely entirely on imported components. Rupee depreciation directly increases production costs. By 2025, India's manufacturing profit margins had fallen by 2.8 percentage points year-on-year, with electronics manufacturing experiencing an even sharper decline of 5.3 percentage points. Many companies have no choice but to control their production scale and avoid expanding their capacity, lest they erode their profits. Some might point to India's production-linked incentive scheme, which provides fiscal subsidies for the electronics, pharmaceuticals, and automotive industries with the aim of bolstering domestic manufacturing. While this initiative has yielded some results, such as mobile phone exports surging from near zero in 2016 to $20.4 billion in 2024 and Foxconn planning to double iPhone production in India, these advances have failed to alter the manufacturing sector's overall reliance on imported components. India's manufacturing contribution to GDP stands at just 14.3%, far below the target of 25%. Furthermore, the sector remains entrenched in the lower to mid-tier of global supply chains, lacking core technologies and independent brands. More critically, foreign investors are increasingly reluctant to invest in India's manufacturing sector. In FY 2020, India's manufacturing sector attracted $43 billion in foreign direct investment (FDI). By FY 2024, this figure had plummeted to just $350 million. Although FDI rebounded to $5 billion in FY 2025, manufacturing accounted for only 24.2% of the total, with most foreign capital flowing into services. Without adequate funding, manufacturing's aspirations to upgrade and enhance competitiveness remain mere rhetoric. The data speaks for itself. India's manufacturing exports grew by only 3.2% year-on-year in 2025, which is well below the global average of 5.1%. Electronics exports rose by 1.8%, while auto parts exports increased by 2.5%, both of which lagged behind overall export growth. With manufacturing performing so poorly, how can it drive economic expansion? Now consider the service sector. Services account for over 40% of India's exports, primarily driven by IT services and software outsourcing. Software services exports grew by 6.6% in 2025, with a surge of 12% in June alone, and net service export earnings increased by 4%. On the surface, this sector appears to be the backbone of exports. However, there is a critical issue with the pricing of these services. Their value is largely independent of exchange rates and is primarily determined by global demand and service quality. For example, contracts between Indian IT firms and European or American clients are usually denominated in USD and typically span 1-3 years with fixed pricing, while a depreciating rupee increases the USD revenue converted to rupees. Clients may demand price reductions, thereby squeezing profit margins. Furthermore, the global IT services market is only growing at 4.8%. Although India's growth is slightly higher, it is insufficient to offset weakness in the manufacturing sector. Even more troubling is the impact of US policy measures. The aforementioned increase in the H-1B visa fee directly increases the cost too. Indian IT firms are deploying staff in the US, significantly disrupting the $280 billion tech services industry. The 3.7 percentage points slowdown in India's IT services exports today, US in the second half of 2025 is clear evidence of this. However, some might point out that India's GDP surged by 8.2% in the second quarter of FY 2025-26, overtaking Japan to become the world's fourth largest economy. The IMF even forecasts that India's GDP will reach $7.3 trillion by 2030, which could potentially place it among the top 3 economies. However, it is important to note that this high growth rate was driven primarily by domestic consumption and government spending, with investment and net exports contributing very little. Given the weak manufacturing sector and pressure on services, it is uncertain how long this growth can be sustained. The third channel is the inflation channel. This is the most concerning topic. Will currency depreciation drive up prices? Logically, a weaker local currency should make imported goods more expensive, inevitably pushing up domestic prices. Yet in 2025, India experienced the opposite. Not only did inflation fail to rise, it steadily declined, hitting historic lows. How did this happen? First, the data. Food and beverages account for 54.18% of India's consumer price index CPI, while fuel and electricity make up 7.94%, both of which are critical drivers of inflation. In January 2025, the CPI stood at 4.26%, dropping to 0.71% by November. October saw an even lower rate of 0.25%, the lowest in the current CPI series. Food inflation was even more dramatic, with a year-on-year decline of 5.02% in October, with prices falling in both rural and urban areas. Why is this happening? It is important to note that India imports 85% of its crude oil and liquefied natural gas, as well as significant quantities of cooking oil and electronics. A depreciating rupee should theoretically push up the price of these goods. However, international crude oil prices remained relatively stable in 2025, and the Indian government intervened to regulate the market, effectively containing the impact of rising import costs. Specifically, the government implemented 3 key measures. Firstly, it preemptively stockpiled large quantities of essential foods such as grains and cooking oil to ensure an ample market supply and prevent price hikes. Secondly, it simplified import tariffs on foodstuffs while restricting hoarding and clamping down on speculation. Thirdly, the implementation of GST reforms in September 2025 simplified the tax structure, reducing production and distribution costs and further curbing price increases. Additionally, domestic consumption demand grew steadily without triggering supply shortages or demand pool inflation. This slow inflation was beneficial for India, as the central bank was able to avoid raising interest rates to curb inflation. Throughout 2025, the Reserve Bank of India kept its benchmark rate 6.5%, while also injecting liquidity through open market operations to ease funding constraints caused by foreign capital outflows. Had India followed the example of other nations, where depreciation triggers high inflation and forces the central bank to raise rates, corporate financing costs would have risen, making economic growth more challenging. India has largely avoided this vicious cycle of depreciation gives inflation gives tightening gives growth slow down. The fourth channel involves external balancers and capital flows. Put simply, this concerns the health of India's balance of payments ledger and its ability to retain foreign capital. India has long struggled with a persistent merchandise trade deficit, which widened to $236 billion in FY 2025. This includes a $102 billion deficit on crude oil, a $46 billion deficit on gold, and an $88 billion deficit on non-oil and non-gold items. The root cause of these deficits is excessive import dependency coupled with weak exports. Rupee depreciation should, in theory, improve this situation by boosting exports and curbing imports. However, India imports essential items such as energy and core components, which must be purchased regardless of price increases, making it difficult to reduce import volume. Meanwhile, exports face headwinds from US tariffs and weak global demand, which prevents growth. Consequently, the trade deficit has actually widened. One positive development, however, is India's robust service trade exports, which have offset some of the goods trade deficit. In Q4 of 2025, India's current account shifted from a deficit to a surplus of $9.5 billion. Equivalent to 0.9% of GDP, this improvement was primarily driven by seasonal factors, falling oil prices and the early export of goods in anticipation of reciprocal tariff implementation. Whether this improvement can be sustained remains uncertain. Capital flows present an even greater challenge. India's trade deficit is offset primarily by foreign direct investment (FDI) and foreign portfolio investment (FPI). However, the rupee's depreciation in 2025 triggered substantial FPI outflows, resulting in a net annual outflow of $18 billion. Although FDI has rebounded to $5 billion, it remains subdued in the absence of sufficient foreign capital. The Reserve Bank of India (RBI) has had to draw on foreign exchange reserves to make up the shortfall. Since June 2025, approximately $38 billion in foreign exchange assets have been depleted, and there is an additional net short position of $64 billion in forward contracts. Further reserves will be consumed when these positions are settled. Services accounted for 39.5% of India's FDI in FY 2025, while manufacturing represented only 24.2%. Wholesale and retail trade accounted for 19.1%, agriculture and mining for 7%, and transportation for 5.4%. The primary sources of investment were Singapore 21.3%, the United States 11.7%, the Netherlands 11.5%, Mauritius 11%, and the United Arab Emirates 10%. Clearly, foreign investors prefer the services sector, while manufacturing remains less attractive. This exacerbates the funding challenges for manufacturing upgrades even further. Foreign debt remains a concern. As of September 2025, India's external debt was $746 billion, 19.2% of GDP, 54.1% of which was denominated in US dollars. Any depreciation of the rupee increases the rupee cost of servicing this debt, putting pressure on that. In an attempt to stabilize the rupee, the Reserve Bank of India (RBI) has sold over $30 billion of foreign exchange reserves since late July 2025. On the 7th of January 2026, it intervened again, pushing the exchange rate from 90.35 rupees to the dollar to 89.81 rupees. However, the effectiveness of such interventions is increasingly limited. External pressures such as a strengthening US dollar and US tariffs persist, making it difficult for the central bank to reverse the rupee's long-term depreciation trend solely through dollar sales. On the other hand, foreign exchange reserves are dwindling. Continued large-scale intervention could fuel market concerns about India's international payment capacity, triggering larger capital outflows. The central bank now faces a dilemma: intervene and deplete reserves, or refrain from intervention and risk further rupee depreciation with greater consequences. The fifth channel is the fiscal channel. Put simply, this examines whether rupee depreciation will put a strain on the Indian government's finances. For 2025, fiscal pressures exist, but they are not as severe as many had anticipated and remain broadly manageable. Firstly, regarding the fiscal deficit target, for FY 2025-26 the government set a target of 15.69 trillion, which represents 4.4% of GDP. By November 2025, however, the fiscal deficit had already reached 9.76 trillion, accounting for 62.3% of the annual target, higher than the 52.5% recorded at the same point last year, but not yet out of control. On the expenditure side, subsidies have attracted the most attention. The depreciation of the rupee has increased the cost of imported goods such as fertilizers and fuel, forcing the government to increase subsidies. In the first 80 months, government subsidy spending reached 2.88 trillion, completing 75% of the annual target and growing by 3.2% year-on-year. This increase was significantly lower than expected, primarily due to relatively stable international commodity prices and the government's optimization of the subsidy structure. Funds were prioritized for critical areas, such as ensuring the fertilizer needs of small and medium-sized farmers were met, while subsidies in inefficient sectors were reduced to improve capital utilization efficiency. On the revenue side, a surprising bright spot emerged. Non-tax revenues performed exceptionally well. Non-tax revenues reached 5.16 trillion rupees in the first 8 months, achieving 88.6% of the annual target and growing by 20.8% year-on-year. Dividend income from public sector enterprises, state-owned banks and the central bank totaled 3.39 trillion rupees, surpassing the annual target by 4%. This revenue offset the shortfall in tax revenues. However, tax revenue has been less than ideal. In the first 8 months, tax revenue amounted to 13.9 trillion rupees, only 49% of the annual target, representing a 3.4% year-on-year decrease. This was mainly due to personal income tax relief policies and short-term fluctuations in indirect taxes resulting from GST reform. Fortunately, robust non-tax revenue means that experts expect the annual fiscal deficit to remain within the target range and avoid significant overshoot. It is also worth noting that fiscal health is intrinsically linked to economic growth patterns. Steady expansion in the service sector has generated substantial tax revenue, while sluggish manufacturing growth has constrained related tax collections. Furthermore, the government's infrastructure investment spending has grown at a moderate pace, thereby avoiding excessive fiscal strain. Additionally, the Indian government is advancing the privatization of state assets, thereby attracting private capital to participate in infrastructure development and broadening financing channels. This has further alleviated some fiscal pressures. Long-term economic development. First, let's revisit the chain reaction of the sentiment channel. Foreign portfolio investors are highly sensitive to exchange rate fluctuations. When the rupee depreciated from 86 to 91 in 2025, such volatility inevitably raised concerns about investment erosion. For example, if a foreign investor held $10 billion worth of Indian stocks, would they be able to exchange 860 billion rupees at the beginning of the year, but only 910 billion rupees by the end of the year? In fact, the opposite occurs. The rupee's depreciation means more rupees can be exchanged for the same dollar amount. Consequently, when converted back into dollars, the value of the foreign investor's assets decreases. For example, if their assets were worth 860 billion at the start of the year, they could exchange them for $10 billion. By the end of the year, the same assets would only be worth $9.45 billion, a direct loss of $550 million. Naturally, they would withdraw capital to preserve their initial investment. Throughout 2025, foreign investors withdrew $18 billion from Indian equities and sold $4.5 billion worth of bonds. This caused government bond yields to rise by 0.8 percentage points and bond prices to fall. Stock market volatility also increased, with 18 instances of daily swings exceeding 2%. Panicked retail investors exacerbated short-term fluctuations by following suit. Fortunately, domestic institutional investors absorbed some of the selling pressure, preventing a systemic collapse. However, their capacity is limited and they cannot fully offset the impact of foreign capital withdrawal. This market volatility directly undermined business confidence. The Confederation of Indian Industries Q4 2025 survey revealed that just 38% of companies were optimistic about the economic outlook for the following 6 months, a 15 percentage point drop on the previous quarter. Over 60% of companies plan to proceed cautiously or postpone investments, with an astonishing 72% of manufacturing firms holding this view. The reasons for corporate investment hesitation are straightforward. Firstly, cost uncertainties. Rupee depreciation makes imported components increasingly expensive, squeezing profits. Secondly, there are bleak export prospects. High US tariffs and weak global demand mean that any expansion of production capacity could result in unsold goods. Thirdly, there are financing concerns. Capital outflows have tightened market liquidity, raising fears of future loan shortages. Without corporate investment, economic growth loses momentum. India's capital formation rate, one of the 3 engines of growth, dropped by 1.3 percentage points in 2025, with manufacturing investment growth at just 2.1%, far below GDP expansion. The number of new project launches fell by 8.7%, and large-scale industrial projects declined by 12.4%, reflecting extreme corporate caution about the future. The impact of this is delayed. Delayed investment now means lower future production capacity, stalled technological upgrades, and reduced employment. In the long term, India's potential growth rate will decline, thereby weakening its global competitiveness. More alarmingly, this chain reaction becomes self-reinforcing. Rupee depreciation gives foreign capital flight gives. Market volatility gives falling business confidence, gives investment freeze, gives slower growth, gives further rupee depreciation, creating a vicious cycle. For example, increased foreign capital outflows in August 2025 fueled market concerns about India's economic health, causing the rupee to depreciate by 2.3% within a month. This triggered further short-term capital flight, creating a depreciation capital flight further depreciation spiral. The Indian government and central bank are exploring solutions, such as central bank intervention in foreign exchange markets and liquidity management, as well as government efforts to optimize foreign investment policies and advance free trade agreement negotiations. However, it will take time for these policies to take effect, making it difficult to break this cycle in the short term. A closer look at growth channels reveals India's dual-track economy. Manufacturing relies heavily on imports, while service exports hold a significant share but suffer from rigid pricing. This structure means that depreciation is ineffective at stimulating growth. It actually hinders it. Consider the contradiction within manufacturing. High import dependency coupled with low value-added exports. Most Indian manufacturing exports consist of assembled or processed goods with core components that are entirely reliant on imports. Import dependency for electromechanical products is 68%, whereas for automotive parts and electronic components it exceeds 80%. Rupee depreciation increases import costs, eroding the price advantage of export products. Between 2015 and 2025, import costs for manufacturing components increased by 8.3%, with electronics manufacturing seeing an 11.2% rise. Profit margins fell by 2.8 percentage points and export-oriented enterprises saw a decline of 4.5 percentage points. In order to preserve profits, companies had to control their production scale and were unable to expand exports. Furthermore, India's manufacturing competitiveness remains weak. Although many multinational corporations pursued a China Plus One strategy to shift production capacity to India, including Apple, Samsung, and Flextronics, India captured few opportunities. Most transfers went to Vietnam, Indonesia, and Mexico instead. Why? Primarily because India's tariffs are excessively high. In an attempt to protect domestic industries, India imposes steep duties on imported raw materials and components, which drives up manufacturing costs and deters foreign investment. As of 2024, India accounted for just 1.8% of global manufacturing exports, far below China's share. Infrastructure and business environment issues persist, including high logistics costs, outdated ports and railways, and cumbersome land acquisition and labor regulations. While the government is implementing reforms, businesses continue to face challenges. Many companies operating in India have had to postpone or even withdraw their production capacity due to difficulties. Even India's competitive manufacturing sectors, such as pharmaceuticals, remain reliant on imports. Although India is a major global exporter of generic drugs, it imports large quantities of pharmaceutical raw materials and intermediates. In 2025, import costs increased by 7.6% due to rupee depreciation, putting pressure on profit margins. Adding to this, increasingly stringent global pharmaceutical regulations have made exporting more challenging and limited growth potential. Similar constraints are evident in the automotive sector, although electric two-wheelers and compact cars are selling well, positioning India as an alternative production base for Japanese manufacturers. Core components such as batteries and motors continue to be imported. The rupee's depreciation has driven up costs, undermining profitability and export competitiveness. Turning to the service sector, there is pricing rigidity and external demand volatility. Although IT services exports remain India's mainstay, pricing is unrelated to exchange rates and is determined solely by global demand and service quality. Contracts denominated in USD and involving long-term commitments mean that rupee depreciation offers no pricing advantage. Instead, it may trigger clients demanding price reductions. Furthermore, with the global IT services market only growing by 4.8%, India's strengths cannot offset manufacturing weakness through this channel. Adding to these challenges, The increase in US H-1B visa fees raises costs for Indian IT firms sending staff to America, thereby undermining their service delivery capabilities. Slowing growth in IT service exports to the US further weakens the service sector's supportive role. Beyond IT services, tourism and logistics, key service industries, also struggle amid the global economic slowdown, and are failing to emerge as new drivers of export growth. Thus, with manufacturing unable to drive growth and services facing bottlenecks, India's GDP growth of 8.2% in Q2 2025 relied on domestic consumption and government spending, a model that is difficult to sustain. The IMF forecasts India's GDP growth at 6.6% for FY 2025-26 and 6.2% for FY 2026-27 precisely because it recognizes these structural challenges. If India fails to address its dependency on imports in manufacturing and alleviate external pressures on services, the constraints on growth resulting from rupee depreciation will become increasingly evident, posing greater challenges to the resilience of its economic expansion. Having covered these 5 channels, let's summarize the unique circumstances surrounding India's inflation and fiscal policy in 2025. While many anticipated that rupee depreciation would trigger soaring inflation and widening fiscal deficits, the reality has been low inflation and manageable fiscal conditions. This outcome stems primarily from the combined effects of government interventions and the global environment. Regarding inflation, the government's regulatory efforts have been instrumental. Measures such as pre-stocking food supplies for market stabilization, adjusting import tariffs, cracking down on hoarding and reducing distribution costs through GST reforms have effectively curbed price increases. Together with stable international commodity prices, steady domestic consumption demand and balanced supply and demand, inflation has remained naturally subdued. Low inflation has enabled the central bank to avoid raising interest rates, maintaining a loose financial environment that supports economic growth, a positive development for India's economy in 2025. In terms of fiscal policy, moderate growth in subsidy spending and robust non-tax revenue offset shortfalls in tax revenue, keeping the fiscal deficit within target ranges. Government initiatives to optimize subsidy structures, advance asset privatization and attract private capital to infrastructure projects have also alleviated fiscal pressures. However, fiscal revenue's reliance on non-tax sources raises questions about sustainability. Sluggish manufacturing growth has slowed related tax revenues, impacting long-term fiscal health. Should international commodity prices surge, a global recession occur or extreme weather disrupt domestic agriculture, inflation and fiscal pressures could rise, necessitating continued government preparedness. Finally, let's discuss India's challenges regarding external balance and exchange rate stability, along with potential future scenarios. India's structural commodity trade deficit, volatile foreign capital flows, and limited scope for intervention in the foreign exchange market have created a triple-edged dilemma for the Reserve Bank of India. Intervention depletes reserves, while inaction exacerbates exchange rate volatility. There is widespread market fear that if India fails to improve its merchandise trade, balance and attract foreign capital inflows, the rupee may depreciate beyond the 9521 USD threshold. This would trigger a series of escalating risks, including rising external debt servicing costs, accelerated short-term capital outflows, increased costs for import-dependent industries, and potential downgrades in international credit ratings. The external environment remains unfavorable. US. Tariff pressures persist with no resolution inciting trade negotiations. Global growth is sluggish amid weak international demand, and the Federal Reserve's rate hikes have strengthened the dollar, putting depreciation pressure on emerging market currencies. These external factors, intertwined with India's internal structural issues, make the situation more difficult to resolve. However, some positive signals are emerging. Trade negotiations between India and the US continue to progress, with the chief economic advisor anticipating an agreement by March 2026. A successful deal could alleviate pressure on the rupee's depreciation and improve the external balance. Additionally, India is advancing free trade agreement negotiations with the EU, aiming to diversify export markets and reduce dependence on the US, which could present new opportunities. From a broader perspective, the rupee's depreciation reflects a common challenge faced by many emerging economies: how to balance dependence on external markets and capital while maintaining economic autonomy and stability in a globalized world. India's experience shows that structural issues cannot be resolved by adjusting the exchange rate alone. Fundamental improvements in economic resilience and competitiveness require comprehensive measures such as industrial upgrading, optimizing the trade structure, enhancing the business environment, and diversifying diplomatic engagement. India's future economic trajectory depends on the effectiveness of its domestic policies, as well as on shifts in the global economic landscape and geopolitics. Its experience of navigating the rupee's depreciation offers valuable insights for other emerging economies. After all, in today's globalized world, no economy operates in isolation. Currency fluctuations in one nation can trigger chain reactions that impact the stability of global industrial and supply chains. Today, we have spent considerable time examining the impact of the rupee's depreciation on India's economy. From its 5 transmission channels to its effect on specific industries and enterprises, and finally its impact on the prices and employment concerns of ordinary citizens. We believe this has provided a clearer understanding of the issue. Economic phenomena often reveal this pattern. Seemingly counterintuitive outcomes stem from deep structural causes. By systematically unpacking them, we can uncover their essence. Finally, here is a thought to ponder. What do you think India should tackle first to break free from this predicament? Should it reduce its dependency on imports in manufacturing, improve its business environment to attract foreign investment, or push for trade diversification? Share your thoughts in the comments section. That's all for today. See you next time.